Hi, everyone, and welcome to the Cover Call Strategy course. My name is Stephen Cox, and I'm the CEO of Navigator, and I'm a full time options and futures trader. This Cover Call course spans over 5 episodes, and we're going to use a real life example with NVDA, and we're going to show you how you would go about picking your strike prices, your expiration dates, depending on what your goals are. In this video, we're going to focus in on NVIDIA and a real life example, explain exactly what the covered call is. And as we progress through the other episodes, we're going to discuss how you would go about picking your expiry dates, your strike prices, what some of the Greeks mean for your position, and also how would you go and place this trade on an online broker and manage it on an ongoing basis. So before we get started, if you like this content and you would like us to continue providing content on option trading, please like and subscribe to our channel and share this video. It's very important for us. If we see an interest, we'll continue to produce these videos. Okay, so let's get started. So the best way to explain the covered call strategy is with an example. So you're looking at a chart here of NVIDIA, and you can see that since April, NVIDIA has gone from $100 to trading now at about $204. So I want you to imagine you're one of the lucky ones that own the 100 shares of NVIDIA, and let's pretend that you bought the shares at $140. Now that the stock price is trading at 204, maybe you're faced with a decision. Maybe you're getting towards your target price where you were going to exit the stock. And if that's the case, this is where the cover call strategy will be really useful in helping you maximize your profit. So I want you to imagine that you're getting ready to sell your shares of NVIDIA. Let's say you had said to yourself, if the share price reaches $215, it's currently at 204, but if it gets to 215, I'm selling out. So what I'm going to share with you now is, well, how do I generate an extra premium for agreeing to sell my shares to somebody else? So what is the covered call? Well, a covered call can be applied when you own at least 100 shares of stock. So if you haven't done our basic options course, you would have learned that options are bought and sold in contracts, and one contract controls 100 shares of stock. So in order to be covered by selling a call option, you need to have 100 shares of stock. In our case, we own 100 shares of NVIDIA at $140. The current share price is 203.70, but we're planning to sell out of NVIDIA anyway at 215. So rather than waiting for NVIDIA to get to 215, what we could do is sell a call option. And if we sell a call option, that will give the owner the right to purchase our NVIDIA shares off us at $215 on or before an expiration date. We're going to use December the 19th, which is 45 days from now. And we will collect a premium in of about $860 in total. And we're going to show you where we got those numbers from now shortly. But your key takeaway from this is you can generate an additional $860 in premium for you just for entering into a contract with somebody else and agreeing to sell your shares to them at $215 between now and December the 19th, which is 45 days from now. They don't have to buy them, but they can choose to do so at any stage between now and within 45 days. So where do you do this? You do this on an options exchange, which trades like a stock market. You can buy and sell options on stocks, very similar to buying and selling stocks outright. So what you're looking at here is an option quote, and you're looking at the call options. And on the top left, you can see the share price of NVIDIA is 203.70 at the moment. On the right-hand side, you have these strike prices. And the strike prices there, I've selected range from 210 to 215. We plan on selling our stock at 215. So that's the agreement price, the strike price we're going to pick. And on the left-hand side, you can see the last price for that was 853 that was taken in per share. So that's the one we're going to focus in on. We're going to show you later on how we got more than that. But this is just an example for you to understand that options trade on an exchange just like stocks do. So the covered call strategy is considered just a slightly bullish, even slightly bearish or a neutral strategy. And it's a great strategy you can apply when it's nearing a top. So all you're trying to do is maximize our gains by taking in an additional premium for agreeing to sell our NVIDIA shares. And in our example, we're taking in an extra $860. Again, I'll show you where we got that number from when we get into placing the trade video. For every 100 shares we own, for agreeing to sell it at 215. This also reduces our break-even price on the stock. So let's get into some of the maths on this. And again, it's classified as a defined risk limited reward trade. So here's the reason why. Our maximum profit for this trade is the capital gain we've made on the stock purchase and the stock sale, plus the premium we're receiving in for the covered call. So our NVDA capital gain, remember, we bought the shares at 140. If we do get to sell them at 215, we'll make a $75 profit. We have 100 shares, so that's $7,500 profit from our NVIDIA shares. But don't forget, we've also taken in $860 premium from selling the covered call. So our total profit is now increased from 7,500 to 8,360. So if we didn't do anything now and we just sold the shares at 215, we would only make 7,500. But by selling the covered call, we've increased our yield by $860. But here's another cool feature of the cover call strategy. The break even on our initial purchase of the shares is reduced because think about it, we paid out $140 to buy the shares, but now we've taken in $8.60 per share in premium for selling this cover call. So effectively, it's reduced our break even on this trade to 131.40. Our loss potential is only comes into play if the share price starts to fall below our break-even price, which is unlikely now in this scenario, but it can happen. But the covered call has helped us reduce our loss potential as well because of the premium we took in. So now we need to talk about assignment risk. So if we get to expiration in 45 days' time, if NVIDIA is trading above $215, what will happen automatically is our share price will be sold to somebody else at 215 of NVIDIA. So even if it was trading at 240, it doesn't matter. All we will get is 215. That's the downside of the strategy. We've capped our gains. But don't forget, we were going to sell out at that price anyway. So in that situation, our shares will be sold on us, but we still keep the $860 premium. The other scenario is what happens if the share price does not rise above $215? Well, we get to keep our shares because it's not in the other person's interest to buy them from us at $215 if they can go to the open market and buy them cheaper. But we still keep the $860 premium. So no matter what, we keep the $860 premium. If the share price at expiry is above $215, we lose them. If not, the share price remains below $215, we keep our shares, and then we'll do it again for the following month. So there is an early assignment risk. So what that means is, can somebody exercise their right to take our shares from us anytime within now and 45 days? And theoretically they can, but it doesn't generally happen. The one time it tends to happen is when we're approaching a next dividend date and the stock might be in the money. So what they look at is it in their financial interest to take assignment of the stock and for them to get the dividend? And that only happens if the dividend amount is higher than what the time premium is left in the option. And sometimes it can happen if the shares are deeply in the money. In other words, the share price has risen so much that maybe for whatever reason, somebody might want to take the shares. But again, it's very, very unlikely to happen. And again, all that happens there when the exercise early is you would lose your shares and you get to sell them at $215. You keep the $860 premium. So the goal of the strategy in summary is to collect premium. Most people will want to keep their shares if possible and just keep selling the premium month on month. However, if it's a situation the share price does rise and you get called out and your shares are gone and you want to get them back, then you can switch to the short put strategy, which we've already covered. And this is where you're getting paid for agreeing to buy somebody else's shares if they fall back to the level you originally owned them at. So you can generate premium again. And folks, this is the power of options when you know what you're doing, how you can use them to your advantage. And finally, I just want to mention that for those of you who might be holding shares, you may have got them through stock options over the years. This is a great way of generating income. Okay, so the cover call strategy is a fantastic way for you to generate premium on stocks that you already own, especially if you're getting to a point where you're considering selling your stock. Why not generate extra income? Doesn't make any sense not to do that. Over the next number of videos now, we're going to start discussing some of the finer detail of the cover call strategy. And we're also going to show you how you would actually place the trade in a real life option trading platform and how you would manage that trade in an ongoing basis. And more importantly, teaching you what strikes you should be picking and what expiry dates you should be picking. So that's all coming up in the next 4 episodes. But again, if you like this content, you think it's worthwhile, please like, subscribe, and share the Share Navigator channel. Thanks and bye for now.